Good afternoon. The time is 12:30 p.m. Australian Eastern Standard Time, and you're listening to Angus Geddes, and a very warm welcome to all of you joining me today on this audio. Well, we've had a very powerful week for equities around the globe, with many stock markets chalking up a decent consecutive run of gains to the upside. And as the old saying on Wall Street goes, as goes in January, so goes for the rest of the year. The Dow returned around 6% for the month of January, which ranks January 2013 as being one of the best Januaries that US equities have had for probably 10 years. And certainly the same can be said for many other markets, such as Japan, the Nikkei, the All Ords in Australia, and the FTSE in the UK. So we've had a very strong start to the year, and I think this is a clear sign, really, that the bull market in equities is well and truly underway, and that stock markets have further to run. I have a question mark over the US markets making new highs, and indeed going much beyond those highs, and that's because I think that there's significant resistance on the Dow at around that 14,200 level, and around the 1550 level on the S&P 500. But as I've highlighted and pointed out a number of times in my daily notes, I could be totally wrong with respect to the US markets turning back at those resistance levels, and we may see a scenario where equities actually punch through that resistance level and move a lot higher. Now, what would cause that? Well, I think one catalyst is clearly the Federal Reserve and the other central banks printing all of this money. I mean, the Fed injected something like 80 billion of newly printed money into the system in January alone. So, if they continue to do that, that liquidity is clearly going to find its way into equities. And, I say that because bonds as an asset class really don't make a lot of sense in terms of their current valuations. It's really hard to justify the valuations that the market is currently placing on US Treasuries and indeed many other bonds around the world, bonds, gilts, JGBs in Japan. These bonds are paying very, very, very low rates of interest, and of course the return on cash deposits and term deposits is also very low. So we have artificially suppressed interest rates globally, and of course what's happening is a lot of this cash is now finding its way into the stock market as investors are becoming a little bit more tolerant in terms of taking a risk, less risk averse. They are putting their money to work into the stock market, and arguably they've really got no choice, because a retiree with say $1 million on deposit is really only getting $10,000 to $20,000 a year in terms of interest, which is really hardly enough to live on. So I think that's really what's driving this whole sort of paradigm, this whole shift, and I think it's going to continue throughout this year as equities become the beneficiary of the incredibly low interest rates around the world. But having said that, I think in the near term stock markets are looking fairly overbought, and we could see a short period of consolidation. Typically, we always get a correction in the northern hemisphere spring, which is sort of around April, May, June. It's happened every year for the last 4 years. And I think, the probabilities are that we're going to get a correction this year. Will it be as much as what we saw last year when stocks corrected 10%? Maybe not. Maybe not. It may be that there's just too much cash and excess liquidity sitting on the sidelines waiting for a buying opportunity and a window to move in. We may find that actually acts as a giant cushion. We may find that the correction when it comes this year is a lot more sedate, maybe 5 or 6%. But the mood has definitely picked up in the last few months, and whilst I think there's still a significant number of investors and traders sitting on the sidelines, more and more are capitulating and moving back into the market. So I think this trend is going to continue. Japan was an interesting market to watch this week. We saw the Nikkei reach 11,300. Now my target for the year was 12,000, and when I put that target down and committed that number to paper, the Nikkei was at around 9,300. So, we've seen a significant move in that market, and obviously there's anticipation now that Shinzo Abe, the Prime Minister, is not going to mess around with respect to their own quantitative easing program, and number one on their agenda really is to get the value of the yen down. All of that jaw boning has really worked remarkably well. And we've seen the yen fall from around 80 against the US dollar to around 91, 92 this week. And I think that, if you look at the value of the yen on a long-term chart, it's probably going to go a lot lower over the next few years, particularly if the Japanese authorities are successful in their money printing and their quantitative easing operations. And I think they will be. I think that they will, in doubling the inflation target to 2%, I think they will do what is necessary. I really believe that. And it may mean that they have to monetize their own debt by printing money, by printing additional yen. It may mean that they start buying equities in Japan. And it may also mean that they start buying US and European debt as well. I really believe that they will do that. And if you look at the Japanese stock market, it's like a coiled spring. They had a bubble, the bubble of all bubbles, really, in the 1980s when the Nikkei got up to around 40,000. And the Imperial Palace of Japan was once capitalized at more than the entire state of California. It was a huge bubble, and of course when it burst, it's taken more than 2 decades, which is really on a par with the Great Depression in terms of the Dow, for the Japanese stock market to work its way through that bear market. We've had a number of false starts. We've had a lot of policy errors and a lot of policy malfunctions, and we've had multiple prime ministers come and go. So there's been political instability. But I believe that Japan is now in a new bull market, and we're going to see that stock market move a lot higher this year. I bought a lot of Japanese stocks last year in November, and I continued. I'm aiming to add to those purchases on any weakness in Japan. But for now, I'm content just to let my profits run. The Nikkei is overextended, so I'm just going to be patient and wait for that correction to happen. I think the other interesting market this year is China, and we've seen the Shanghai Composite Index break out of a multi-year downtrend. We've seen some really good, solid price action. And when you think about it, the Chinese stock markets have lost 70 to 80% of their value. The public have been disengaged. This is over the last 4 years. And yet the economy continues to grow at around 8%, if you believe the figures. I think that given that the GDP is continuing to grow, it's only a matter of time before that stock market really turns around and has a major move to the upside. And I think that move has begun and is now underway. So I'm also playing that stock market recovery this year. I think China's going to do exceptionally well. What's good for China is going to be good for the commodities complex, and I think the commodities are all going to recover. We've already seen iron ore bounce convincingly off that sort of $85 low last year, and I think this is also going to be very beneficial for the Australian stock market, which has also underperformed for much of the last 4 years relative to US equities and many stock markets in Europe. So I think this is going to be the year of Asia and Australia. I think Australia's stock market is going to get to at least 5,200, but there is an election to be held later this year, and I think some bit of uncertainty there will keep that market probably the market rally from overheating too much. But again, like the US, I think there's going to be a lot of cash waiting on the sidelines, ready to commit to equities the minute that there's a correction, and I think that in itself will provide a decent cushion, underneath the market. Last but not least, precious metals. We've seen gold continue to trade within a range, and as I highlighted in today's note, very interesting chart structures for each of the precious metals. We've seen a convincing breakout after a 18-month period of consolidation in palladium. And what's interesting about palladium's move to the upside is it now appears to be the lead sled dog of the 4 PGMs, or the precious metal group, which is made up of platinum, silver, gold, and palladium. What we tend to see with this group is they tend to follow each other, and the leadership transitions at various stages, and the timing can be a little bit different. But what we can be quite confident of is that once you get 2 of the PGMs breaking up, or breaking down for that matter, the other 2 will follow at some point. And I think that the next precious metal to break out to the upside will be platinum. I think platinum is going to make that move, and it's sitting at just underneath quite heavy overhead resistance, which has been entrenched, over the last 4 years. So I think that platinum is going to have a move to the upside, and I think gold and silver will shortly follow. What we're seeing with silver is it's consolidating within a triangle trading range, and these typically end with quite a loud bang and a decisive move to the upside or the downside, depending on which way the precious metal breaks. And obviously I have a bullish bias towards the PGM group with all the quantitative easing that's going on around the world at the moment, and I think that we're going to get that breakout before too long to the upside. But it will take probably a move by platinum to really get the interest back into the silver and gold markets. And on that note, I wish all of you a very relaxing and restful weekend, and I look forward to joining you same time next Friday. Bye for now.